Hello, everyone. David Blain here. Happy Friday to you. With this week's sell-off in the market, a little bit of panic going on over the coronavirus, I thought I'd give you our take on the situation. First, as most of you know, that I don't really watch TV, especially not cable news or broadcast TV, and I also don't pay any attention to what's on Facebook, Twitter, Instagram, or any of the other sites that willingly offer you millions of unfiltered opinions on a multitude of topics. I tend to study data and facts, trying to get as close to the source of information as possible, and try not to rely on too many third parties to interpret that data. I'd rather do it myself. And the coronavirus is no exception. And so I'm not an epidemiologist, so I'm really going to stay away from the medical part of the virus. But suffice to say, if you're concerned, I highly recommend you do some basic research on your own into the disease from some reputable sources. There are plenty of US based as well as global health organizations that have some common sense information on the coronavirus. In the information world and media, they're afire with all sorts of many untrue statements, rumors, misleading predictions, and things like that that are easily refuted by a quick read from an official source. So we all need to do our part to make sure we're not contributing to falsehoods regarding this coronavirus. So anyway, after saying that, what's going on with the markets? Well, the coronavirus has impacted global trade. Absolutely. Markets should go down. The stock market is based on the earnings of the companies that make up the markets. And those companies are trying to make a profit. And when they make a profit, they pay dividends and the company becomes more valuable. And so the price of the shares go up. It's a pretty simple equation. Right now, the coronavirus, especially in China, which has a lot of global trade, is shut down to some extent. You know, there's tons of empty hotel rooms, there's closed factories, there's canceled airline trips. Trade has been disrupted in China and other places around the world. And so the earnings in aggregate of companies around the world are going to be lower than we thought before the coronavirus hit. It's pretty simple. And so yes, markets should probably go down a little, somewhat. If you factor in the fact that the markets have been on an 11 or 12-year upward swing, and there's a lot of excessive optimism, people very optimistic about it, any little thing is going to knock the market back. This is the way things work. And that's helped contribute to the severity of the decline. I mean, a week ago, this is how sort of manic depressant participants are sometimes, is investors were euphoric because a week ago the markets were hitting all-time highs here in the United States. And now, following the worst week in a long time, people are pessimistic all of a sudden. I mean, they've completely flipped over. It's just kind of an excessive reaction to the situation. So as we sit here on Friday, February the 28th, you know, the market is down over 10%. What exactly does that mean for your portfolio, you may be asking? Well, even with the 10% decline in the markets, the vast majority of you have followed our advice and hold a diversified portfolio of stocks, bonds, and real estate. The impact has been really muted. I know there's a few of you out there that have 100% stock portfolios because you have other, bonds or a lot of cash somewhere else. You know, yes, this impacts you directly, probably at 10% or so. But for those of you with bonds and real estate, interest rates have actually gone down, which has raised the prices of your bonds, providing a great buffer against the decline in the market. Diversification is working exactly as intended. This is not 2008, where people were panicking over not only the stock market, but the bond market. This is purely an earnings function related to the stock market. The bond market is functioning as should be, and other safe havens. Real estate, because it's very interest rate sensitive, has also either been spared the decline or actually gone up in value. The other thing, I took a look at some of the other impacts of recent health crises. We had SARS in 03, we had the bird flu in 04, we had swine flu in 09. We had the polio virus that kind of came back in 2014. So that same year, we had the Ebola crisis. And then in 2016, we had the Zika virus. And of course, in 20, we have the coronaviruses. And so these type of things are not unprecedented. This is probably not going to turn into the bubonic plague or the Spanish flu or one of these things that wipes out, 40% of the world's population. Frankly, if it does, what's going on in your portfolio is not going to matter at all. I don't think that's the case. But anyway, this stuff will not matter. So we've gone through these type of crises before. I looked at the data, and like most of these type of things, after some of the panic wears off and markets return to normal functioning, yes, there may be a little bit of a decline based on the reduced earnings, but they generally are looking to recover. Also, I took a look just to kind of refresh everyone's memory on regular declines, not necessarily healthcare crisis declines, but any decline where the markets were down, the type of decline that they've been down over the past week or so. And what we see is what this would be defined as a moderate correction. A lot of my data I get from a company called Ned Davis Research. So these statistics come from Ned Davis. So they define a moderate correction as greater than 10%. And so since 1928, this has happened about 98 times, or an average of 1.1 per year. This is normal. Coronavirus or whatever, this happens on average at least once a year. Typically, the decline lasts around 100 days, and the average decline is over 10%, but less than 20. The likelihood of it going to a 15% correction is a little bit less than half. So less than half the time does a 10% correction turn into a 15% correction. Oh, and by the way, this just happened last September. 9/20 of 2018, we saw a decline in the markets of 10%. And the return from that time frame to today has been about 6%. So this type of decline is not unprecedented. Yes, it's been pretty quick, but 10, 15% declines in the market are not unusual. And typically, within 100 days or so, the decline is over. And as we see with this last one, this last was actually positive since September. Sometimes it takes a little bit longer to recover, but in general, we view this as a potential buying opportunity for long-term investors. In fact, I was reading this in the Wall Street Journal today. It's kind of funny. The writer of the article was saying that he was in an Uber this morning, and he noticed the driver fiddling with his phone, and he said, "Hey, would you mind paying attention to the road?" And the driver said, "Well, do you mind if I pull over for a minute because the market's open and I have to sell some things?" And I just thought that was kind of funny. People are really, panicking, and that's what kind of drives the decline of the market. So as you probably know, our philosophy is to hold a portfolio that you can not only emotionally stomach the ups and downs, but can fiscally afford to weather the inevitable declines that happen in the markets. Many people have been overly aggressive during this bull market, and they're really beginning to doubt their strategy this week, and so they're selling out of their stocks. And so while we may make some minor adjustments as we go along due to changing earnings and global markets and things like that, but for the long-term investor, these market corrections are a buying opportunity. So that's really all I wanted to talk about today. Rest assured, we're on top of the situation as best as possible. And as always, if you have any specific questions, please feel free to reach out to your advisory team. Thanks, and have a great weekend.